Everyone and their brother seems to have an opinion these days about how you should invest your money. Some are even saying just to stay on the sidelines and do nothing. So what's the right thing to do? While it doesn't predict future results, we can learn some important lessons by looking at past performance. For instance, even with all its ups and downs, the stock market has shown that it's an effective tool for the everyday investor to potentially grow and accumulate wealth. And it's been pretty good as a hedge against long-term inflation. Consider this. We all know that things like food and gas cost a lot more today than they did 10 years ago. In fact, they've historically increased by an average of 3% per year. Now, if you were to just put your money in a CD that pays, say, 2% annually, and the cost of goods increased by 3%, you wouldn't be able to buy the same amount in a year. That makes sense, right? This is called purchasing power risk. Now, let's take a look at another kind of risk. Because of advancements in medicine and technology, you might well live into your 90s. But then, if you retire at age 60, it's possible you might outlive your money. And this is called longevity risk. So in order to combat purchasing power and longevity risks, experts often recommend you embrace the stock market, not fear it. But why the stock market over other opportunities? Well, because over the past 85 years, the stock market, as reflected in the S&P 500 index, has outperformed other investment tools. The fact of the matter is, while many of us may be very analytical in our professional and personal lives, we are very emotional when it comes to investing. Here are some facts. The average return of the S&P index over the last 20 years was about 8.21%. But here's what's really interesting. During that same time, the ordinary investor in the stock market averaged a return of only about 4.25%. Why would that be? Well, studies suggest that emotional decision-making was the primary reason for this underperformance. In other words, being influenced with stock tips by everyone from your hairdresser to your brother-in-law. Making decisions based on emotion just hasn't worked, and its returns significantly less. Trying to time the market is another example of emotional investing. That is, guessing when to buy and when to sell based on those gut feelings you get in the middle of the night or something you might have heard or read in the media. Decades of research tell a very different story, however. If you invested $1,000 in the S&P index in January 1970, it would be worth about $59,000 today. But say, for instance, you happen to step out of the market during just 15 of the best days, your return would plummet to only about $22,000. Think of it. You're in the stock market and you miss out on just 15 of them, and your return drops by nearly 2/3. A $36,578 difference for just missing a few days. Your timing approach didn't work so well in that case, did it? But rather than timing the market, the best way to create wealth over time might just be time in the market. Okay, so now you've decided that the stock market, even with all its ups and downs, is the way for you to go. The next important principle to understand is asset allocation. Asset allocation is like baking a cake. The ingredients are not something you consider having as a meal, but when combined correctly, the results can be pretty good. However, if you decide to pull out some of those ingredients because you don't feel like using them that day, the end result isn't so great. Emotional investing is exactly like that. In contrast, however, the Portfolio Advisory Services program takes the emotion out of investing and replaces it with a disciplined, academic, Nobel Prize-winning, research-driven approach. The Portfolio Advisory Services program invests in numerous asset classes to build your portfolio. Over time and circumstance, these have performed differently depending on the economic environment and the product or industry to which they are connected. Furthermore, even in crisis situations such as Hurricane Katrina or the recent economic crash, certain asset classes still perform relatively well. So if you own stock in just one or two of these asset classes, you might experience negative returns. But by combining different asset classes into one portfolio, the overall risk of the portfolio is greatly reduced. In fact, the mutual fund holdings in the portfolios we manage contain more than 10,000 different stocks and hundreds of different bonds, spread across 40 different countries. That's called diversification, and that's a key element of a healthy portfolio. The final principle in our disciplined approach to investing is the concept of rebalancing. This means that we make frequent adjustments to the portfolio along the way that allow us to follow the first rule of investing: buy low and sell high. Rebalancing realigns a portfolio back to its original allocation when a stronger performing asset class has exceeded its original percentage, or a weaker performing asset class has become underweighted. Systematic rebalancing also helps us overcome our tendency toward emotional decision making. We believe rebalancing can actually help reduce your portfolio's volatility. So there you have it. The stock market over time has proven itself to be a good investment option because it deals with both the purchasing power and the longevity risks. But emotional investing certainly is not the way to go. Neither is guessing what the next hot stock will be or trying to time the market. Instead, a systematic, academic, and research-based approach has been shown time and again to provide a safer investment path. By utilizing diversification through asset allocation and then regular rebalancing of that portfolio, you can best position yourself to realize your future dreams and then to protect your funds throughout retirement while maximizing your tax situation. This is exactly what the Portfolio Advisory Services program provides. Talk to your investment advisor representative today to learn more about how this approach can be tailored to meet your financial needs and help you avoid the roller coaster of emotional investing. Because when it comes to your future, now's not the time to be rolling the dice. If you're interested in learning more about this program, please speak to your investment advisor representative.